Good evening and welcome to India Now. Let's cut across to the Wipro presser.
Percent sequentially in dollar terms, which is 1.1% in constant currency, in line with our guidance. On a full year basis, we grew 4.6% in reported terms for FY18 and have surpassed the $8 billion mark for our IT services revenues. We entered Q4 with confidence driven by the improvements we saw in our deal trajectory, uptick in the client mining, our performance in digital, and the reduced headwinds in some of our businesses. However, we are disappointed at the loss of momentum in Q1 due to surprises arising out of bankruptcy of two customers, which total almost around $52 million in terms of annual revenues. And there is an additional impact of the HPS business, which continues to see more client exits, the acquisition that we have done, which services the ACA. And the weakness in the communication BU continues. However, all of our core strategic themes have been performing well, and we are confident that we will return to the growth trajectory back in Q2 due to our strong order wins coupled with our strength in digital. Let me give you an update on the strategic themes. Our digital revenues this quarter grew 9% sequentially, and now our digital revenues are 27.6% of our total revenues, as a proportion of our total revenues. In Q4, we closed the highest order booking yet on digital deals. We closed about 70 deals, which are over 5 million last year. Our client mining continues to do well. Our top 10 accounts grew 5.5% sequentially and 14.8% year on year. We also added 3 accounts in the 75 million range, taking the count to 20 such clients now. 2 of our accounts crossed the $250 million run rate in Q4. On non-linearity, we continue to see traction in our homegrown IP around Homes, AssureNext, Delta Verge, with IP revenues crossing $100 million this year, and we filed 2,000 patents as on date. We now have Wipro Homes deployed across 320 customers with 92 unique bots, which is helping us deliver significant service improvements and productivity across all of our run business, testing services, as well as business process services. Leveraging the cognitive capabilities of Homes platform, these bots have helped automate work and generate a productivity of total 8,000 FTEs in L2 and above in all of FY18. Our fixed price mix has reached 58.7% in Q4, which is amongst the best. As a result, our revenue per employee has increased 6% over the last 4 quarters. We continue to focus on localization, and our localization in US has now gone over 55% locals. In Asia Pacific, more than 3/4 of our employees are now local, as well as in Latin America, almost 100% of our employees are local. This quarter, we announced the divestiture of our DCS business for a consideration of $405 million, and we expect that transaction to complete during the current quarter. This will enable us to strategically leverage our cloud services to transform our infrastructure customers, leveraging both public and private cloud. In Q4, we continue to see momentum build up in Wipro Ventures, with 18 new deployments of our various Wipro Venture IP, including threat management, test automation, conversational AI, and so on and so forth. Overall, in FY18, we incubated 19 themes in our intrapreneurship program, which we called Horizon, including 5 themes on technologies like additive manufacturing, autonomous vehicle, industry platform solutions, etc. With that, now I will request Jatin to give more details and color on our financials.
Good evening, ladies and gentlemen. As always, pleasure to have you here. I will walk you through the key financials for this quarter ended 31st March 2018, as well as for the year ended for the same date. The revenues of our IT services business was $8060 million or $8 billion, which was a 4.6% growth year on year. And for the quarter, while our guidance was 1 to 3% in constant currency, we are at 1.1%. In reported currency, we delivered 2.4% sequential growth. Our margins for the year were 16.8%, adjusted for a couple of one-time charges that we had to take. And if we don't take that, that number was 15.8%. And if we adjust for the currency, we were broadly in a very narrow range of FY17 margins. For quarter 4, that number was 16% and reported number was 14.4%. Our net income for the year was rupees 80 billion. And as you might be aware, we completed a very large buyback program in December where we bought back to the tune of rupees 11,000 crores worth of Wipro shares. And that impacted our other income for the year and for the quarter. Therefore, our net income for the year and for the quarter remained marginally lower than respective periods in respective previous periods. Our realized rate for IT services for Q4 was 65.04, and our effective tax rate for the full year was 21.7%. As for the operating cash flows and overall management of working capital, as you can see, our operating cash flows were 84 billion Indian rupees, which was 105% of our net income. We continue to generate healthy cash flows, continue to manage our working capital proactively, sharply. We also improved our days sales outstanding, what is popularly known as DSO, on a year-on-year basis by about 2 days. So overall, a satisfactory year from operating cash flow and overall working capital management standpoint. Let me talk about our business units. On a full year basis, our largest unit, Banking, Financial Services and Insurance, BFSI, grew 14% year on year. Manufacturing grew nearly 6%. From a geography standpoint, our investment in continental Europe continues to pay rich dividends. We grew nearly 10% year on year in Europe. And our traditional strength in Asia Pac continues to give us good growth in Asia Pac as well. Among service lines or services, digital grew 27.3% year on year, and application services, which, as many of you might recall, was a slow growth service line for us for many years, has been ahead of company growth rate in FY18 at 6.2%. Similarly, for the quarter, BFSI continued to do well at 4.7%, manufacturing at 4%. US was 2% sequentially, nearly 2% sequentially at 1.7%. And among service line, product engineering services grew 8.1% in dollar terms. Among some of the other highlights, we surpassed $8 billion mark in IT services. Our consulting, which is another strategic thrust for us, grew 26% year on year. In last 1 year, we have added 5.5% revenues, which is quarter 4 over quarter 4, while our net headcount are actually reduced by 1%, and this shows the strength of our automation, productivity, and non-linearity initiatives. Another strength is the farming. Our top 10 accounts grew 5.5% sequentially and nearly 15% year on year. We added 3 accounts to a 75 million mark on a trailing 12 months basis, and 2 of our accounts crossed $250 million mark on a run rate basis in quarter 4. We expect our revenue from IT services business for quarter ending June to be in range of $2015 million to $2065 million in the currencies which are stated on the slide. With that, we are very happy to take any questions you may.
Hi, Abid Chandra here. Just want to understand, you mentioned in your CEO address as well how you're disappointed with the loss of momentum in Q1 because of these 2 bankruptcy clients. Barring that, would we have seen a better Q1 from Wipro? Because now you've sort of guided to degrow going by the current estimate. Because Q1 for Wipro has traditionally been weak in the last few years, despite this being one of the strongest quarters for IT companies traditionally. For Wipro, it's been the opposite. So are there other factors impacting Q1 for you? And Jatin, I know you mentioned a couple of exceptional factors that led to your margins coming down this time. But if I look at the entire year, it's been coming down. You ended FY 16-17 at 18%. You're ending the current the last financial year at 15.8%. So do you expect this to improve in the coming quarters, despite the increase in non-linearity and automation? Why are we not seeing that reflect on margins, or is there pressure on pricing? If you can give us some perspective there. Thank you.
So Q1 primarily, we although came within our guidance and did well in Q4 in terms of revenue growth. In Q1, we have primarily 2 major headwinds. One is, while the cost impact of the bankruptcies show up in the Q4, the revenue impact, as I said, of an annualized revenue of about $50 million, the quarterly component shows up immediately in Q1. The second is HPS, which again, we've had a couple of further, our customers exiting the market, and that impact shows up in Q1. So those are the 2 primary impacts. Otherwise, the rest of the business is in line with our cyclic performance. As you rightly said, we have normally a softer Q1 because some of the productivity and the way our contracts are structured show up in Q1. But primarily the reason for a more headwind that we see in Q1 is because of these 2 factors.
The divestment that you announced, you said it'll be completed in the current quarter. So that's not included in the guidance, is it?
Yeah, that is not part of the guidance. And as and when we complete the divestiture, because we are going through the customary closing things, including regulatory approvals, etc., we will announce it. And if there is any change in outlook at that point in time, we will formally share it. But right now, we have assumed a business as usual guidance as we see it.
Right. Abid,
Jatin, hi,
from
BTVI. Sir, just wanted to understand from you the margin erosion picture or the margin expansion from here on. How are you looking to prevent any further erosion on margins? And the client-specific issues, sir, that you pointed out, the 2 unfortunate incidents that you mentioned, just give us a highlight of how much more, or what is the internal assessment of what kind of issues one can see in India or Middle East? I mean, client-specific issues. That's what the streets and analysts are looking out for.
Sure. So let me go through the margin picture, I think, which was also part of the earlier question of Chanda. So if you see our adjusting for one-timers of FY18, we are at 16.8%. And if you see the overall year-on-year impact of Forex, which would be roughly 1%. So adjusting for Forex, we have in a very narrow range of what we were in FY17 versus FY18. I agree, there has been a volatility, but there has been volatility caused by a couple of factors. As HPS revenues have come down, we have worked hard to remain cost neutral on that basis. Also, India and Middle East has been some quarter a good story, some quarter still hiccup. So that has been some factors, couple of factors which have impacted the operational profitability for FY18. Going forward, we believe through the year we will improve the margins. But in quarter one, we will have the revenue headwind as well as the 1 month impact of the salary increases that we'll give from 1st June. And we'll have to work through that.
Any kind of range of the expansion you said? And also I had asked for the client-specific issues, if you can answer. Abid.
So I think, as I said earlier, the margin impact for the 2 client bankruptcies has been taken in Q4, and the revenue impact is reflected in our guidance in Q1.
Also, please identify yourself before asking the question.
Hi, Abid Rukmani from CNBC TV 18. Though you have kind of factored out why you have given, such low growth rate for next quarter, but you also say that, starting Q2, you'll see the growth trajectory coming back, and also you're seeing strong deal wins. If you can really, quantify or give some color into which are the areas that will probably be seeing growth, and also Jatin, if you can break down the margin impact that you've taken this quarter, if it's entirely due to the client-specific issues or others also. Thank you.
So our deal wins, as I said, has been one of the strongest year for order booking for us. We don't give out the numbers for order booking, but it is one of the highest order booking in our history. We see good deal wins across the board, primarily through digital, from verticals perspective, whether it is the healthcare vertical, the BFSI vertical. We do continue to see some softness in consumer and telecom, which continues. No, I'm talking about the deal wins. So once we take some of these impacts that we've had in Q1, that is how our confidence in terms of continuing our growth trajectory in Q2 and going forward.
Yeah. So, Rukmani, I will answer your question on margin walk, but I'll also want to take a step back and tell you that some of the building blocks for a superior margin is visible now. They are in form of the farming. So if you see our top 10 customers, this quarter has grown 5+%, 5.5, full year has grown 15%. Our digital revenue, which typically comes at premium, have grown 27%. Some of the numbers that we have talked about the deployment of automation and homes. I think these are playing out in terms of revenue productivity, which I spoke about, which is adding 5% revenue without. So I think we have building blocks. Right now, for the quarter one, we will have headwind. But as I mentioned, during the year, we will work through the margins. For quarter four specifically, to your questions, our margin on normalized basis was 16% vis-a-vis 17%.